I am Deborah Murad. I'm the Executive Director of DG Copyright Management, and we're so happy to bring you this incredible week of programming on estate and legacy planning. For those of you not familiar with DGCM, I'm just going to tell you the cliff notes. We were actually formed by the Guild a few years ago to manage works that were bequeathed to the Dramatists Guild and its sister organizations. And what distinguishes us from other agents, publishers, executors, is that we are concerned primarily with authorial intent, with your authorial intent. And it is your intent that guides our management style to ensure that your work is always properly managed. We collect statements of authorial intent, and we defer all difficult authorial decisions to the Dramatists Guild Council. So when you're enrolled with DGCM, you do always know that it's the top playwrights, composers, lyricists of the time making those difficult authorial decisions, and that it is your intent that is really guiding what happens. So if you're looking to get back to the Guild, looking for a place to leave property, not sure what to do, just want to talk it through, come to one of our sessions. We've got one tomorrow at 3 and one at Friday at 6, or you can always email us, and I'll drop everything into the chat for you in just a moment. But what is most important about this week is not that you enroll with DGCM at all, but that you do have a plan in place for your songs, for your lyrics, for your musicals. They are like your children, as I always say, and you do need to care for them. You need to figure out who's going to care for them and what their destiny will be. And that's really what this week is all about. It is your right to have those works protected. And those works live on for their full term. And now, tonight, we have a very special presentation by Elaine Grogan-Luttrell. Many of you already have seen some of her financial seminars. I know I tuned in myself. She's got a series going on at the Guild, but she was gracious enough to join us and flip a few things around for us so that we can learn some special secrets tonight that relate to your planning, to your a little bit to your retirement, a little bit to your taxes. I'm going to let her tell you more about that. And before you all groan and say taxes, I don't want to do that. I promise you that if anyone can make this interesting, it's Elaine. If you have not seen her other programs, you will enjoy it. Let me tell you a little bit about her. She works to build financial literacy in creatives and in creative organizations through education and through coaching. Her work focuses on connecting financial decisions with creative goals. So really a useful person to have on your team. She's hosted master classes at the Kennedy Center's DeVos Institute, I hope I'm saying that right, of Arts Management, which is now based in Maryland, and also the Pew Center for the Arts and Heritage, the Foundation Center, the Arts and Business Council of New York. The list goes on and on and on. She's super entertaining. She's going to make all of this stuff very understandable to her. And before I take up any more of her time, I'm going to pass the mic over to her and excuse myself, but I will be dropping into the chat all the registration information. Please feel free to use the Q&A if you have any questions today. The chat is actually going to be disabled, so questions go in the Q&A. And with that, take it away. Thank you so much for being here.
Thank you for having me, Deborah. This is such an important conversation. So huge thanks to DGCM for hosting this and jumping into this National Week of Awareness and Building. It is such a pleasure to be here. As Deborah said, make sure all of your questions go into the Q&A, and I promise we will get to all of them throughout this conversation. We had originally thought about talking about kind of retirement and long-term planning, but as the content evolved, we're sort of pivoting into something that's more like easing into your estate financially, more or less. We'll still have a lot of conversation around retirement because, believe it or not, that does inform eventually what might be part of your gross estate. But we wanted to sort of broaden the content to really respect the entirety of the conversation that's been going on this week, because it is absolutely vital to have those conversations. As Deborah mentioned, my name's Elaine. I use she, her pronouns, and I am joining you this evening from Dublin, Ohio, which is just a smidge north of the capital, and it is Kashkashkia and Hopewell Indigenous and Cultural Lands. In case you're listening instead of watching, I'll share a visual description of myself. I am a 40-year-old white woman with wavy blondish brownish hair that continues to get long throughout this pandemic, even though I swear I'm going to keep trimming it. And I am wearing a tweed jacket tonight in a nod to our crisp autumnal weather that I am super excited about. As Deborah mentioned, my background is in finance and accounting. I am a CPA by training, and I hold a personal financial specialist designation. And I'm also an accredited financial counselor. And a few years ago, I finished a program in financial therapy. So that collection of letters basically just means we can talk about taxes, we can talk about accounting nuances, we can talk about investments and financial planning and budgeting. And I can hand you tissues as we have all of those conversations, because they're really hard to have in the arts. And there are a lot of nuances that come into those conversations. And it's that human side of money that I am particularly interested in, because after all, we're all navigating some of these challenging things together. I am also the absolute luckiest money person ever, because I get to hang out with creative organizations and their supporters and creative individuals all across the country all of the time. And I feel so incredibly privileged and grateful to be doing this work. As we dive into this, I think it's important to say that all of this information is educational in nature. It's not intended to be tax or legal or accounting advice. A lot of these things are really nuanced and complex. And if you find your interest piqued by some of these topics, definitely be sure to follow up with someone who can really kind of dig into your own specifics as part of that conversation. So in our time together tonight, we're talking about a lot of different things. And very specifically, I wanted to sort of introduce the estate tax exemption and call out some of the changes to this over time. And then we'll spend some time defining the components of your estate. And this is where some of that retirement conversation is going to come into play. And then we'll talk about some strategies essentially to meet your goals, one of which could be to minimize your estate. And another one could be simply to use this moment to think about some of these things that you maybe haven't had occasion to think about before. So we'll start with the exemption. What is this exemption? Essentially, this is a big number. Currently, it is $11.7 million. And this exemption is the amount of your estate that can be passed tax-free to your heirs. And what that means is if your estate is lower than this number, you probably don't have to lose a lot of sleep over estate taxes, because this exemption is relatively generous and it will cover many, many individuals in the world. And the way we sort of get at this number is thinking about what the value of your estate is. So anything that's left after you pass away, all of that goes into your gross estate. And then we reduce that by some allowable deductions. So you get to the amount of your estate that could be taxable. And then we apply that exemption. So anything that's left over at the end is what's subject to the estate tax. So in this example, let's pretend your gross estate is worth $15 million. And this is a huge number, but once you start counting in all of the things you own, you might be surprised at how this number sort of nudges upward. Maybe not to $15 million, but it surprisingly can get rather large. Then in this example, so this person has $3 million of estate deductions. They end up with a $12 million taxable estate. And after applying the exemption, the amount that's subject to the estate tax is $300,000. So that would translate into tax of $87,000 and some change, which is not an insubstantial amount, right? That's almost a 30% effective tax rate. And that can really take a chunk out of what is left for your beneficiaries. So that 11.7 million number is the first one to sort of keep in mind. But as I mentioned, this number changes over time, and it has not always been quite so large. In fact, we don't have to go back all that far in history to see that the exemption used to be quite a bit more modest. So if we look back to 1997, which many of us remember pretty well, the estate tax exemption was $600,000. Now that is still a big amount of money, but in the context of your estate, especially when you're thinking about something like life insurance covering some portion as well, that exemption can go pretty quickly. You'll notice the amount of the exemption increased over time. And then at the end of 2017, it was just under $5.5 million or so. And I do not have to remind you that at the end of 2017, the Tax Cuts and Jobs Act was passed. And I know that has had a huge impact on your industry in particular. So we recall that that was major legislation. And one of the provisions as part of that legislation was essentially doubling the estate tax exemption. So that's how we jumped from 5.5 million to quite a bit more immediately in 2018, and then it's been increasing with inflation ever since. Now, this provision of the Tax Cuts and Jobs Act is set to expire at the end of 2025, which is not too far away. And at that point, the estate tax exemption is set to go back to basically 2018 levels, unless Congress takes additional action. And I don't know about you, but I have no idea what Congress will do. So keep in mind that 11.7 million is a huge amount, and it will be about half that-ish in the not too distant future when these amounts go back to pre-Tax Cuts and Jobs Act levels. So your quickie summary about what to know is that the federal estate tax exemption is $11.7 million, and this amount changes over time. But you'll notice there I said it's the federal estate tax exemption. And as you know, we have taxes imposed at the federal level and also at the state level. And that is also true about estate taxes. Now, not every state imposes an estate tax, but there are a handful that do. And those states are presented here on the slide. You'll notice there are quite a few states in here that many of you might live in because they are artistic hubs and there are wonderful things going on in them. In each of these states, each state has a slightly different estate tax exemption. And those amounts range from about $1 million to $5.74 million. That's the amount for New York State, by the way. The New York State estate tax exemption is $5.74 million. So note that you might live in a state that also imposes an estate tax, and the exemption might be quite a bit lower than the federal amount, which might be something for you to pay attention to. You'll notice Maryland is starred here. Maryland is a lovely state, one of my favorites, and it's also a state that imposes an inheritance tax as well. The inheritance tax is slightly different than the estate tax because the inheritance tax is paid by the heirs, the people who inherit portions of someone's estate, whereas the estate tax is paid by the estate. This is enough to drive you crazy about tax world because it feels unnecessarily complicated, but it's worth paying attention to if you live in one of the states that shows up either on this estate tax list or on this inheritance tax list, just so that you're aware of what the implications could be to your estate or to your heirs down the line. So, just a reminder, 11.7 million is that federal exemption amount, and states impose estate taxes and inheritance taxes as well in some cases. So note if you live in one of those states that you probably need to spend some time thinking about this. And that might be in a way that's different from someone who doesn't live in one of those states. So all that knowledge is helpful and interesting or boring, I think, depending on your perspective. But let's translate that into something you can actually do. And so when I was thinking about how you could use this information, I kept coming back to sort of the typical goal we would think about when it comes to estate tax planning, which is lowering the value of the estate, strategically decreasing it so that you can be exempt from taxes or minimally affected by estate taxes. But there's also a second goal that I think it's worth paying attention to. And that's this idea that thinking about this information, especially in the context with all the programming that's been going on this week, is a really good opportunity to maybe check in with things like life insurance and your retirement planning and some of these other big deal things so that you can start thinking about them and exploring if there are actions that it makes sense for you to take. There's a question in the Q&A from Alicia. Alicia, thanks for your question. Is the inheritance tax paid by heirs in the state where heirs live or where the deceased lives? Usually it's where the deceased lives, but states can adjust this and write whatever rules they dream of. So it's a good thing to sort of be aware of no matter what. Thanks for that great question. So if we go back to this calculation of estate taxes, a simplified calculation, we start with the value of the gross estate, then we have those deductions. Now remember, we can't control what happens with this exemption amount. We've seen it change over time and range from a relatively small number to relatively large numbers. But what we can control a little bit more is the value of the gross estate and also these estate deductions we might be eligible for. So that's where the energy in planning tends to be focused. So let's dig into this idea of the gross estate. Your gross estate essentially includes the value of everything you have when you pass away. And generally speaking, things are valued as of the date of death. There are some nuances where you can choose an alternate valuation date, but in general, we're thinking about the fair value of things at the date of death. And sort of the first big bucket of assets tends to be real estate. So this would be any real estate, real property you own, and we would value that at the fair value. So what we would call the gross market value. We think about the mortgage you might have on that property, but that comes up in a later part of the calculation. So for purposes of valuing the estate, we think about the fair value of the gross value of the real estate. And then the next big category of things that go into the estate include jointly owned properties. So this could be anything that you hold in conjunction with someone else. Oftentimes, this is a spouse, but it might not necessarily be a spouse. I could see a scenario where you might jointly own copyright to a piece of music or to a written work that you co-wrote or co-created with someone else. So that would fall into this jointly owned properties category. And again, the value is often the fair value at the date of death. So keep in mind and maybe take a moment just to check in with yourself to see if there are jointly owned properties that you might need to think about because your portion will be part of your estate. And then we have life insurance. Life insurance is another sort of big category of things that goes into the value of your estate. And when it comes to life insurance, very often people purchase life insurance and then the proceeds are used to cover end-of-life costs or funeral expenses or taxes even, or costs to settle the estate. And often there is a portion left over for the beneficiaries as well. The amount of life insurance that is received is considered part of the estate. So you could think about a scenario when maybe you're paying attention really closely to the real estate you have, maybe to the investments you have, and the other assets that are maybe sort of obvious to think about. But if you have a substantial life insurance policy, that amount could nudge the value of your estate upwards in a way that might be problematic if you haven't planned for that. So keep in mind that the life insurance proceeds are going to be part of the estate as well. And this brings us to kind of our first real planning opportunity. So if you are someone who's looking at these numbers and you say, I want to absolutely make sure to exclude this from the value of my estate, there is an opportunity, or I should say there may be an opportunity to put the life insurance proceeds in an irrevocable life insurance trust. And by doing that, by forming this irrevocable life insurance trust, you are essentially carving out the life insurance proceeds from the value of your estate, which means the value of your estate will no longer include the $1 million proceeds or whatever it happened to be, which means we've effectively lowered the value of your estate. And I want to address Rob's question here. Rob says, I thought life insurance proceeds were tax-free. They are tax-free. Your life insurance proceeds are tax-free, but they get counted in the value of your estate, right? So you're not paying income taxes on them, but they go into the value of the estate. And then if the value of the estate ends up being bigger than that exemption amount, then the estate pays estate tax on that, right? So lots of nuances going on here, right? Life insurance proceeds are tax-free and they are part of the value of the estate, which could then eventually be subject to estate taxes. So thank you. Great clarification there, Rob. I appreciate that. When it comes to these irrevocable life insurance trusts as well, if this is something that might make sense for you from a planning perspective, there is another sort of timing thing to pay attention to. If this irrevocable life insurance trust is formed within 3 years of the date of death, then the value is not excluded from the estate. So if you are thinking about this, or if this might make sense for you, this is not something I would put off until the last possible minute. We want to go ahead and set this up. It is irrevocable, right? So you definitely want to be paying attention to that, but I wouldn't wait until the last possible moment to set this up. Great, great question. So what do we now do with that information? I would say now's a good time to check in with your life insurance coverage. Check in to see, number one, if you have it, if what you have makes sense, is an appropriate amount, is covering what you want it to cover and providing for those you want to provide for. And then after you've sort of checked in with your life insurance levels, then I might investigate that policy to see if it makes sense to think about putting it into an irrevocable trust. And the times that that might make sense would be especially if the value of that life insurance policy would push you above that estate tax exemption, because moving it into a trust would effectively lower the value of the estate. So that could be an option that might make sense for you to think about. And I would say also, just as sort of a general global point, gut check your life insurance on a regular-ish basis. Circumstances change all the time, and your needs change, your family's needs change, and we want to make sure we are taking into account those changes as you're thinking about what type of life insurance might make sense for you and your family. So now we're going to move on to this next category. This is this category of investments, right? We've talked about real estate. We've talked about jointly owned properties and life insurance. The next kind of big category of stuff that goes into the estate are your investments. So we think of these as classic investments, stocks, bonds, mutual funds, anything you might be invested in. This also includes notes or any mortgages that are owed to you by others. So that would go into this investment category. And of course, it includes any cash you have, the literal cash that might be in your home, for example, and also cash that's stored in a checking account or a savings account, right? So all of those types of investments end up being added together and going into this category. And again, we value these at the fair value as of the date of death, which is generally a pretty easy valuation to get, especially for investments that are regularly traded. If it's for a more nuanced investment or one that is not quite so actively traded, you may need, or your heirs may need, to bring in some valuation specialists to help provide a value of what the investment is worth as of the valuation date. And for many individuals, most of the investments, or at least some of their investments, are tied up into retirement accounts, right? So the beneficiary of your retirement accounts will receive the money, although the money is still included in the estate. And the beneficiary might have a ton of flexibility in deciding what to do with those funds, or they might have very little flexibility. So if your beneficiary is your legal spouse, that person has the most flexibility of all, which is wonderful. They can roll the proceeds into their own account, into a new account, tons of different flexibility there. And whatever they receive will have the same tax treatment that it had when it was in your retirement account, whether it was pre-tax or tax deferred. Now, if your beneficiary is not your spouse, right, then they have more limited flexibility. Now, if they are a minor, if they are disabled, if they are chronically ill, or not less than 10 years younger than the original owner, they have a little bit more flexibility. But if they're none of those things, the non-spouse beneficiary has to spend down all the retirement proceeds within 5 years. Now, that has been extended to 10 years because of the Secure Act, but it's set to revert to 5 years. And Rob's question, the Q&A, is, what do you mean spend down? Do you mean that one might have to take required minimum distributions? Rob, it's even worse than that. Let's pretend I pass away, and let's pretend the value of my IRA or my retirement account is $500,000. And let's pretend I leave that to a beneficiary who is not my spouse and doesn't meet any of these other sort of special provisions. That means under normal circumstances, that person would have to take the entirety of the distributions, not just the required minimum distributions, but all of the distributions within a 5-year period, right? So if someone, my non-spouse beneficiary, receives my $500,000 retirement account, they would essentially have to take out $100,000 a year for the next 5 years. Now, because of the Secure Act, they'd be able to take $50,000 a year over 10 years, which is pretty good. But still, if you think about a beneficiary receiving that, that's going to be problematic from a taxable income perspective, particularly if the non-spouse beneficiary is receiving any sort of federal benefits, or maybe has an income-based repayment plan for their student loans or anything else, right? So Rob, it's more than just the required minimum distributions. It's that entirety has to be distributed within now that 10-year period, thanks to the Secure Act, but under quote unquote normal circumstances, it's 5 years. So pay attention to that. And that's another reason when we think about these retirement accounts, right? Remember, you have a retirement account that you have already paid taxes on. So like a Roth account, for example, you already pay the taxes on the principal that goes in. So that means if you leave a $500,000 Roth account to a beneficiary, right? And let's just say, for pretend, the entire $500,000 is principal. In that case, the beneficiary would take out $100,000, but they wouldn't be taxed on it because you had already paid those taxes. The opposite is true for a 401k or a 403b or a traditional IRA. Because remember, we don't pay taxes on those dollars when we contribute them. We pay taxes on them when they come out in retirement or when our beneficiaries are forced to take them out. There's a comment. So could an asset be subject to estate tax and an inheritance tax? Seems unfair to pay twice. Yes, it could be. And yes, that is unfair. As of this moment in time, Maryland is the only state that has both an estate tax and an inheritance tax. So that idea of the same asset being taxed twice, once at the estate level and then once to the heir or the beneficiary level, Maryland is the only state where that could come up. But yes, you're absolutely right. Something could be taxed twice. Someone else asked, could I clarify the not less than 10 years younger? The double negatives have me confused. Yes, boy, do they. This is such classic tax law double speak, right? So this person continues and says, my sister is 4 years younger than I. Is she okay? So what I think I understand is that you have the retirement account and your sister, who is not your spouse, is 4 years younger than you. So this person is not less than 10 years younger than you. This person, not less than 10 years younger. This person is not less than 10 years younger, which means your sister has more flexibility. Your sister would not have to spend down the retirement within 5 or 10 years. So yes, she is okay, I think is the long-winded answer to that. And just make sure, be aware that your sister is just sort of, knowing that she's the beneficiary and that when that happens, which hopefully will not be for a very, very long time, your sister can have some counsel and support as part of that process. Because remember, there could be taxable retirement and also tax-free retirement kind of all baked together there. Another question, can you take out early distributions before 59 and a half due to an illness for cancer? Yes, generally speaking, you may take early distributions, and in some cases that might make sense. There may be tax implications of those early distributions, but that would definitely be part of something where we would just work through the math and make sure everything made sense. And the tax implications may affect the amount of the distribution you choose to take. A question from Joan, what if you don't have a beneficiary? What if you have bequests going to charities? This is a great question, Joan. The way this would work is the value of your retirement would be included in the estate. And then as part of your estate deductions, you would then reduce the value of your estate by that amount. So let's pretend, Joan, you have retirement that's worth $1 million. That $1 million would be counted as part of your gross estate. And then as part of the estate, you have bequested that to a charity. So then there would be $1 million deduction from your estate for that charitable contribution, which means the value of your estate would then go down. So it goes up by $1 million, then it goes down by $1 million because you're leaving it to charity. So it's totally fine. A question here or comment from BC Granger, the spend down requirement then is only for retirement benefits and not also a requirement for those other elements of the gross estate portfolio. Yes, absolutely, and excellent clarification. This idea of having to spend down the retirement in these circumstances is only for those retirement accounts. It is not for the real estate or other investments you might have that are not part of a retirement account. This is only for those retirement accounts. And this person says, they ask because I'm planning to leave your legacy to your godson who does not meet those qualifications as specified. So yes, totally fine. As we're only talking about retirement here for these kind of spend down requirements. So that might influence your retirement planning as well. You know, I am all for saving for retirement, and let's not save too much so that you put an undue pressure on, for example, your godson or someone else that might then be in a position where they have to take distributions. Lucy asks, what if a non-spouse beneficiary is a nonprofit? Does it pass to them tax-free? Yes. And this kind of works with, so again, we're talking about sort of the retirement account. So if the retirement account has the beneficiary that is a qualified charitable organization, right, that sort of meets the tax code definition of that, and most nonprofits do, then yes, the value of that retirement would be included in the estate, and then the estate would get a deduction when the amount is transferred to the qualified charitable organization. So great question, Lucy. Okay, thank you for all these good questions. Oh my gosh, they're so fantastic. Let's see, and Michelle, I see your question about trusts as well, and we've got a little bit more content coming up about trusts, so that's why I'm pausing on that. So thanks. So remember, we were talking about retirement here, right? And what happens to the retirement account as part of your estate. And as we're thinking about spending down the value of your estate, or if we're thinking about maybe lowering the value of the estate to avoid the estate tax, often there is an opportunity to reduce your estate while you are in kind of that pre-estate world by spending down some of the investments you have, which is essentially spending more than what you are bringing in when you're in this later in life period, right? So here's where I'm going to step aside to do this brief retirement sidebar, because, you know, sometimes these things are tightly intertwined. So when we're thinking about your retirement, right? And in the arts, retirement doesn't necessarily look like retirement might for a lot of individuals. Your retirement can look like whatever you want it to look like. But for individuals in the retirement season of their lives, more or less, they generally have income, possibly from Social Security. So you may have some Social Security income in your retirement. And you may also have what I'm calling business income. And this could be any number of things. This could be royalties. These could be licensing distributions. You might continue to teach in some capacity and have income from that, even if you're teaching at a reduced schedule or something. So there are lots of sort of business or creative type dollars that might be coming to you. I could also see scenarios where you are paid as a consultant to consult on different projects, or where you are asked to serve as a juror for various prizes or other things, and there's some honorarium that comes with that, right? So your retirement, unlike some individuals who really might not be working in any capacity at all once they quote unquote stop working, you may still have income from these various sources tied to your creativity. Now, that is almost impossible to predict, but it's something to sort of keep in mind as you are thinking about what your retirement season of life might look like. And you can do some very rough estimates of what that might be. You also may have distributions from any accumulated retirement you have, right? So let's pretend you worked very hard your entire life, you saved for retirement when you could, and you have accumulated some retirement assets. As you're thinking about what this looks like in your retirement, maybe it makes sense for you, especially if your beneficiary for your retirement assets would not necessarily be your spouse or have some of those flexibilities, right? Then you may want to perhaps not spend from your business income, since that would simply go into your investments or your cash or your savings account. And maybe you intentionally spend down from those retirement assets so that you're lowering the value of them that might be left to your beneficiary, especially if your beneficiary is the same for the cash in your savings account and your retirement, right? That could be something to think about. Or if you are like Lucy or Joan and the recipient or the beneficiary of your retirement is, say, a charitable organization, maybe in that case, you say, okay, I'm going to take the minimum distributions from my retirement, preserving as much that could go to the charity. And then I'm going to use some of this business income when it comes in to live on. These are the type of sort of puzzling together of the income questions and planning that we would look at as we're thinking about what your retirement looks like and what makes the most sense contextually for you and for your family and loved ones, your charities, and other beneficiaries you may have. I have a couple of different types of retirement accounts listed here, right? 401k is the traditional retirement account if you work for a for-profit company. 403b is its equivalent if you have worked for a nonprofit. So if you were an employee of a theater, for example, a nonprofit theater or a college or university, there's a good chance you will have a 403b account in lieu of a 401k, or maybe in addition to one if you have spent time on both sides of the industry. If you have ever had self-employment income as well, which most people in the arts have at least at some points in their careers, there's also an opportunity for you to open some special retirement accounts that are designed for self-employed individuals. The SEP, S-E-P IRA is one of the more common ones. There's also a simple IRA, but I don't like it as much as a SEP. SEP gives you a little bit more flexibility. And there's also something called a solo 401k. And all three of these are retirement vehicles that you can have if you are self-employed. And there are different limits about what you can contribute to these retirement vehicles on an annual basis, generally tied to your earnings from self-employment. But if you are someone that has self-employment income and you are looking to reduce your current year tax obligations and or set aside some funds for your retirement, a SEP or a simple or a solo 401k could be a good option for you. There's no need to rush on this. You have until you file your tax return for 2021 to set this up for the 2021 calendar year. So just file that away and know that it could be an option as part of your overall retirement planning. And it's a pretty good option if you have a high level of self-employment income, or if you don't work for somewhere that has access to a 401k or 403b. It's also interesting to think about either a traditional or a Roth IRA, and many people end up having both a traditional and a Roth IRA. These individual retirement accounts are ones you start without thinking about self-employment income and without having to be employed by a for-profit or nonprofit that offers those retirement vehicles. Now, the contribution to your traditional or your Roth IRA is limited to $6,000 a year, and you generally have to have some type of earned income in order to be able to contribute. So in a year where you might not have had earned income because, say, there was a pandemic and everything was shut down, that might not be a viable option for you. But know that there are options for you as an individual to contribute to a traditional or a Roth IRA. There's a question from Rob. Are there restrictions on having a SEP or simple if you have a traditional union defined benefit pension? Yes, there are. So there's an annual contribution limit that you are allowed to make as a human, right? So this year, I think it's $55,000, it might be $56,000, but that is the total amount from all sources that you are allowed to essentially defer from taxes. So if you have already hit that limit through any other type of plan, maybe it's a 401k, maybe it's another type of pension. If you have already hit that limit, then even if you had additional earnings from self-employment, you wouldn't be able to take advantage of them because you had already hit that overall deferral limit. But you could, for example, have a SEP and say a traditional or a Roth IRA, because the Roth IRA limit is $6,000, but the SEP limit, for example, is 25% of your net earnings from self-employment. So in that case, you can kind of do the math and puzzle out, what's the apps, how can I get as close as possible to that annual deferral limit, assuming you're in a position to be able to do that. Great question here. This person says, can you still start a SEP, simple or self-employed 401k after you've reached retirement age? Yes, although there are some extra limitations. As you are getting closer to retirement age, you are able to increase your contributions. We call them catch-up contributions, specifically to IRAs. So there could be some finagling there. Once you are retired, we would really look to see what your self-employment income looks like, because that's going to sort of govern what the overall limit could be. And that would be part of sort of a bigger conversation and planning option. So great question there. So that's all the income side of retirement, right? Money that could be coming in when you are in the retirement phase of your life. You're also going to have expenses as part of your retirement life. And generally they include your regular living expenses. Sometimes financial planners will estimate that your retirement expenses might be about 80% of your non-retirement expenses, but that's not my favorite way to estimate them. That is a quickie shortcut, and it's not the worst starting point. But that assumes a lot of things that might not necessarily be true. In fact, since humans continue to live longer and longer and longer, in some cases and in some places, we're seeing that medical costs in retirement and also costs of care in retirement sometimes more than make up for spending you might not have in retirement, like a mortgage, for example, if you have fully paid off your home by the time you retire. So it really does make sense to kind of dig into the numbers and estimate, knowing that it will be an estimate, but estimate what your living expenses might look like in retirement. And this is very, very personal. It depends on the humans around you, your travel preferences, certainly where you are living and the cost of living associated with those places, right? So lots of different things can go into that. You also will likely have some business expenses, especially if you continue to teach or produce or consult or serve in some kind of capacity. And I think it's also important to think about the expenses you might have associated with this legacy planning piece, right? As you're thinking about maybe hiring an assistant to kind of pull together some of your documentation, or you're asking for someone's support in a data entry project associated with documenting kind of your legacy. There might be expenses associated with that are worth thinking about and planning for. And then, of course, as part of your retirement, we have this lovely category of gifts. So this is where it can be really interesting to think about what your gift planning situation looks like in the context of your expenses in retirement. and also in the context of using your retirement to possibly lower the value of your estate. So when we kind of think about the numbers on either side of this, right, what it essentially boils down to is if the money coming in retirement is more than your expenses, basically what you're doing is growing your estate, right? You're making the net value of everything you have get bigger because you're bringing in more money than you are spending. Now, that's a really good thing throughout most of your life. We like to see more money coming in than is going out. But if your plan is to shrink or lower your estate, you want the opposite to happen. You want your income to be less than your expenses. So there are some things you could do. You could decline income, refuse an honorarium for judging something, right? You could minimize your retirement distributions, at least until those pesky required minimums kick in and you have to take them, right? But what you could also do is look at this expense side and think about maybe growing those expenses, especially when it comes to thinking about gifts that you might be giving away, because that gift tax threshold is $15,000 or so. So it might make sense for you to cover travel expenses for your grandson, for example, or gift an amount to someone close to you, which essentially is shrinking the value of your estate. So those are the types of things we'd want to be thinking about as we're thinking about what your retirement is looking like and how what you're spending in retirement and what you might still be earning or bringing in retirement is contributing to your estate. Joan's got a question. Are SEP plans always tax deferred? Yes, I believe so. I don't think I've ever heard of an example where a SEP is treated like a Roth. I think by definition, they are always tax deferred. So great question there. So there's a lot going on there. But I want to also draw your attention to another key point that we've touched on a couple times. The other opportunity here, especially when it comes to increasing your expenses, is thinking about contributing some of these investments you may have to charities, right? And this can be part of your overall plan for benefiting organizations that you care about. We've already talked about how you can name an organization as the beneficiary for some of your retirement assets, which is great. And as part of maybe spending down your investments, you can think about making very intentional charitable contributions during your retirement, and even before that, if you feel so inclined. So you can donate appreciated investment assets, which can be a powerful tax strategy. And then essentially the organization gets the fair value of the amount that they receive on the date of the transfer, assuming they sell the investment right away. You also could have an option for a charitable remainder trust or a charitable lead trust. These are two different vehicles. And what essentially happens is you put some money into this vehicle, and then the organization gets the whatever is left upon your death, or they get the upfront amount. So it's a remainder trust that they get, or the lead amount they get. And then the individual receives distributions until they pass away. So as you're thinking about this overall planning, especially if some things you're looking at are, do I need additional income, right? Having a charitable remainder trust could be an opportunity to receive an annual payment from that investment, from that trust. And then when you pass away, the organization would receive whatever is left in the trust at the end. These are complex instruments, so they might make sense for you, and they could be part of this overall estate planning opportunity, depending on what you're thinking about. And then the other thing you can think about, you've heard me mention RMDs, and I think you heard Rob mention RMDs as well. These are required minimum distributions you must take from your retirement accounts, even if you don't necessarily need the money. So once they kick in, you have to take the money. And that is taxable income to you if this is a tax deferred retirement account, right? So in that case, you can choose to direct your RMDs to a qualified charity, which means you don't get that taxable income. The money goes directly to the charity. So then if you don't need the funds and you'd rather direct it somewhere else, that can be a way to minimize your taxes in retirement and also not grow or accumulate your estate, especially if you're in a position where you're planning to spend more than your income. Directing some of those required minimum distributions away from you can be a way to do that as well. There's a question about how much can you roll over from a traditional or SEP per year into a Roth? And I have to admit, I don't recall what this year's annual limit is. We're talking about maybe some backdoor conversions or something like that. So I can get back to you and look up that limit for this year. Or if someone knows, by all means, definitely feel free to add in. And then Rob has also called out charitable gift annuities. Yeah, these are similar to a charitable remainder trust. In many cases, they're a little bit easier to execute, and they can serve as ongoing income and also provide a gift to a charity you care about. So thank you for that, Rob. That is a fantastic addition to this list of options that might make sense. So with all of that, because remember, we're still talking about that kind of investment bucket of your gross estate, things that it might make sense for you to do, especially at this moment in time, or as you continue thinking about this, think about estimating your income and expenses in retirement. I know the estimate will be imperfect, but you know yourself best, and you might be able to start putting together some rough numbers about what this might look like. Depending on where you are in your career, it might be a really good time to set aside some funds for retirement as you're thinking about what your income needs might be and what your expenses might be in retirement, whatever that looks like to you. And then if you are in the season of life where we're thinking about minimizing the estate, think about ways to what I'm calling increase your expenses. But what I really mean is, spend more than's coming in retirement, specifically through charitable contributions, additional gifts to friends and family or loved ones, so that we can begin sort of holistically planning the estate. And then, of course, we always want to consider ways to think about your own charitable priorities as part of this overall plan, because there can be some really effective strategies there. So that's that investment bucket. The last bucket of things that go into your gross estate is this lovely category called miscellaneous property. And this is the category that will probably cause you the most headaches because it's sort of a catch-all category. And you'll notice rights and royalties fall within this category. So this is where if you do have rights or royalties, as you probably do in terms of your intellectual property and your creations, they would be valued and included in your estate as part of this miscellaneous property category. Other things go in there too. If anyone owes you money, not as a mortgage, because that goes into investment, but if someone owes you money for something else, that would go in there. If you have an ongoing business and an ownership of that business, so ongoing income streams or something like that, your business interest would go into this miscellaneous property category. All of your personal things, your car, etc., that all goes in here. And the big challenge here, especially especially when it comes to your business interests and rights and royalties, is usually around valuation. So we would always aim to use the fair value at the date of death or the alternate date, but sometimes that's hard to quantify. So odds are there will need to be a specialist involved who will help with that valuation. So often that's not something you can explicitly do before you have an estate, but you can start the conversations, especially if you were thinking about your gross estate in total, so that you can have a sense of, how that valuation may impact the total amount of your estate. So within this category, there's also an opportunity to kind of reduce that miscellaneous property amount. And I wanted to call out kind of 3 ways of doing that. One thing is certainly gifting personal effects, right? As I mentioned, the gift tax exclusion is $15,000. So to the extent that you have things, personal things, business things, journals, meaningful things that you want to make sure to give to someone else, if you go ahead and make that gift in advance of when you die, and if the value of those things are less than $15,000, those things are no longer part of your estate. You've gifted them to someone else. So that could be a strategy that makes sense for you. You could also think about sharing a business interest with others. So let's pretend you are the sole owner of your business. That would be part of your estate as part of this business interest. And we would value that as essentially your equity or the ownership interest in the business. But maybe it makes sense for you to bring in another person to be a co-owner of that business, right? Specifically through a family partnership or some other familial structure, right? Which means it could then have a portion of that ownership excluded from your estate. So let's pretend, for example, you want to bring on your child as a co-owner of your business. You bring them on, you set up a family partnership, right? All of a sudden, you don't own 100% of that family partnership. You own 50% of that family partnership, which means that 50% of that business interest will be part of your estate instead of the entire 100%. Now, this would definitely be an area where you would want to bring in an accountant or an attorney, because as you're setting up these entities, especially if you are doing this as part of an estate planning process, we want to make sure we are complying with the letter of the law. And there could also be gift tax consequences depending on the value of the business. So definitely consult some outside expertise if this piques your interest. But then the third thing you could do is think about using a trust, which would essentially exclude some of the assets from the estate. And generally or often, this can be effective in this miscellaneous property category. There are, if you'll permit me, a handful of benefits to call out to using a trust. The biggest one, and the one that makes the sense in the context of this conversation, is reducing your taxable estate. Because again, any property that is part of the trust is excluded from your estate, which means it makes the value of that gross estate lower. Things in a trust also, because they're outside of the estate, completely avoid probate. So that is another benefit. And anything that's within the estate could be claimed by creditors to settle debts you might leave behind. So if something is not part of the estate, then you are essentially protecting it from any creditors that maybe you know about or that might surface at some point in the future. There are also some benefits to having property in a trust because of privacy concerns, right? There's no public airing of anything when it comes to a trust. So that could be an effective strategy, especially, for someone with creative assets that it makes sense to exclude and maintain some privacy around. And then, of course, there's also some control benefits of having a trust. So this could be a potential option. And Michelle, I hope this is a helpful extra context to your question, right? So you might have a special trust as part of this, which could be different from your irrevocable life insurance trust. So think about, or maybe loop back in with the attorney that prepared your will, just to kind of make sure what is set up is meeting your needs and your expectations. Of course, there are some drawbacks too, right? Time, expense, and complexity are the big drawbacks to having a trust. This can be amazing and effective, and it definitely might make sense for you in the right circumstances, particularly if some of these benefits are very important to you, or if you are specifically looking to lower the value of your gross estate. But it's complex, it's expensive because you need the support of an attorney and probably an accountant, and it's not necessarily a quick process. So keep in mind that, this may not be the perfect choice for everyone, but if it's the right choice for you and these drawbacks are not real drawbacks, it's definitely something to think about. And as part of the resources shared this week, there's the DGCM video, Reasons to Use a Trust, that I will direct you to, because that is excellent. Oh, and Julius, thanks so much. It seems like the live transcript has stopped updating. I am sorry about that. We'll see if someone on the back end could maybe help with that. So as we're thinking about this, sort of your action items, or what I might suggest could be action items, are definitely to consult with an estate planning attorney and or an accountant. Because again, this is complex, right? So if a trust makes sense for you, definitely call in some experts and get the help you need. And as you're thinking about this, beyond simply thinking about a trust, as you're thinking about what's going to happen to some of the things you care about, think about what that looks like in terms of gifts to friends and family, especially being mindful of that $15,000 annual gift tax limit, right? That's definitely something we want to keep in mind as part of this planning process. That is a limit per person, per recipient. So let's pretend you and your legal spouse each want to give $15,000 to your 2 grandchildren. You can both do that. Each person can gift up to $15,000 to a single recipient, right? So there's some interesting things you can do when it comes to this gift tax planning, particularly when you have a longer time horizon as part of your retirement, to think about that. Which means, again, we want to start thinking about the income and expenses we might have in retirement so that we can be making those choices instead of panicking about them. And then I will also say, this is not a financial action item per se, but as you're thinking about gifting things that matter to you, particularly with respect to your intellectual property and your creativity to others, have a conversation with them. I think this has been a point that's been reiterated a couple of times this week. So definitely have those conversations so you can be clear about what your wishes and intentions are, and those around you can be clear on how to best honor those. So that's essentially everything that goes into the gross estate. But remember, we have the gross estate and we also have these estate deductions. So this is kind of the second opportunity to reduce your taxable estate by maximizing or increasing these deductions. So I wanted to call out a couple of the biggies here just to help you think about sort of planning going forward. The big categories of estate deductions, first of all, include funeral expenses and administration of the estate, right? So these can be sizable and they are deductions to the estate, which is good. Funeral expenses that are unreimbursed count as a deduction. If you have, for example, military benefits or something else that would reimburse funeral expenses, you can't deduct them because that would be double dipping, but that's okay. Also, your estate might have attorney fees and accountant fees. It might also have appraisals, particularly with respect to some of that miscellaneous property that might be hard to value. And there could be court costs, storage fees for different things, disposal fees, any number of expenses that can come up. All of those funeral and administrative expenses with respect to the estate reduce the value of the estate because they're deductible. The value of the estate is also reduced by debts you owe to others. The biggie is often any remaining mortgage on the real estate, but there could be other debts as well, and those all reduce the value of the estate. Now, one of the largest categories of debt in the United States are student loans. Now, if you have federal student loans at the time of death, those loans are discharged. Now, normally when loans are discharged or forgiven, it counts as taxable income. However, the Tax Cuts and Jobs Act made the discharge of federal student loans tax-free through 2026. So know that that is not a permanent change, but it is a change for the next couple of years. And depending on all sorts of congressional action, this could be continued, or there might be larger movements to forgive more aspects of federal student loans. But know that your federal student loans are discharged due to death, which is a good thing. It's also worth noting that if you have private student loans, they may or may not be discharged. Many private student loan servicers will discharge student loans upon death, but some will not. So that's something that the executor will look into as they process the estate to figure out what debts related to student loans still must be settled and which ones are fully discharged. So file that away in case that is helpful as well. Then we have a large deduction, or potentially large in some cases. We call it the marital deduction. And the marital deduction means that amounts can be transferred tax-free to the surviving spouse, and the value of whatever is transferred reduces the gross estate. That's a big deal, right? Because when we think about the value of the estate minus those deductions, if essentially everything or a large percentage of the value of the gross estate gets transferred to the surviving spouse, in that case, we've effectively eliminated more or less the taxable estate, which is a really, really good thing. I will note, though, in order to claim the marital deduction, the amount that is transferred to the surviving spouse has to match what is listed in the gross estate. So all those valuations have to match up. So this is definitely an area where you would want to take full advantage of hiring an accountant to help file the estate tax forms and make full use of that marital deduction. Now, for the second time this week, I am going to give a hat tip to Edith Windsor. Edith Windsor and the case United States v. Windsor was touched on by Max Elliott earlier this week in an amazing presentation that was focused on LGBTQ issues that might come up as part of estate planning. And if you don't recall, Edith Windsor was unable to claim the unlimited spousal deduction or marital deduction because her marriage was not recognized at the federal level, even though it was recognized in her state. So essentially, the tax court case that overturned the Defense of Marriage Act was essentially a tax case, right? It was held by the Supreme Court, right, and found by the Supreme Court, but it was a tax case because our tax laws discriminated against Edith Windsor by making her pay estate taxes when, if her marriage were legally recognized, she would have gotten the full marital deduction, which is unlimited. That's a big deal. Now, I will echo Max's points from earlier the week that marriage equality could be overturned, and there are all sorts of chaotic things happening right now. So settled is not always settled. However, because of this, it doesn't matter at this moment in time who you are married to, everyone gets an unlimited spousal deduction, which is a good thing. And then there's another piece about portability. And this word portability in the context of estate tax means that any unused estate tax exemption, and remember, right now it's $11.7 million is your estate tax exemption. Anything that is unused can pass to the surviving spouse. So what that essentially means is that the surviving spouse basically doubles their estate tax exemption if none of it is used by the spouse who passes away first. So that is a really, really big deal, and it can be very effective, especially as we think about how the value of this estate tax exemption can change. You definitely want to make sure that the surviving spouse takes full advantage of carrying over or taking that portability for that estate tax exemption that the first spouse that might pass away won't use. So that means you got to file an estate tax form. And again, lean into the experts for help on this, especially when it comes to valuation and that marital deduction, because it can get kind of tricky. And then to claim this portability, it's called the deceased spousal unused exemption, which is maybe the least, interesting or heartfelt description of anything ever. But if this is something that's going to make sense for you and or your surviving spouse, this is definitely something that you want to be aware of as you're thinking about the estate planning. So turning all of that into some action items, make sure that you or your surviving spouse have support when it comes to filing the estate tax returns and, kind of loop them in, particularly if you find yourself as sort of the financial person in the relationship. Not that there's always one person, but if it's primarily you, let's go ahead and make sure that your surviving spouse is set up and well taken care of to navigate these really complex issues to take full advantage of the portability and the marital deduction. So those are the first three ways you can use deductions to reduce the gross estate: funeral and administrative expenses, any debts that you may owe, right? Especially something like a mortgage that would be attached to the value of the real estate. And then the marital deduction, which of course is unlimited, which is lovely. The last biggie deduction that comes into play are charitable contributions you may make. So as you're thinking about any contributions that might be made to charity, these can take some different forms, right? You can expressly leave certain amounts as part of your will. As we talked about earlier, you can name charities as beneficiaries of different instruments or vehicles. That might make sense, right? So these charitable gifts and the deduction for them could be coming from some different places as part of your overall estate tax calculation. And then we would value that at the amount that is actually paid as the estate is settled. So keep that in mind as well, particularly if you are someone that plans to leave the entirety of whatever is left in the estate to a charity. It will be impossible to say exactly what that number is, but as everyone kind of goes through the process of valuing the estate, the charity will be notified about whatever is left at the end. So again, think about charities that you might like to support as part of your estate, and think about ways to incorporate that support in whatever makes the most sense for you, whether it is through, directing required minimum distributions from your retirement account to those charities, leaving an amount at the end, or exploring a charitable remainder trust, or even a charitable lead trust, or those charitable gift annuities that Rob reminded us about, because there are a lot of good and interesting options there that could make sense as part of a big comprehensive plan. So there was a lot of information there, and I hope it wasn't too overwhelming. We tried to keep it simple and focused and relevant, but it's also complex and nuanced, right? So if I were to kind of summarize the key points and think about or make some offerings about what you could be doing now, I'm going to go back to kind of the things to know and the things to do and recap and summarize them. One big thing to know is that the estate tax exemption is $11.7 million this year, and that amount changes over time, as we've seen. It's also worth knowing whether or not you are in a state that imposes an estate tax, an inheritance tax, or both if you have the privilege of living in Maryland. So make sure that's part of what you are considering as well, instead of hearing a number like 11.7 million and assuming that none of this applies to you. And then it's also worth paying attention to how you may fund your later life and what it may cost. And again, it's impossible to know. There are way too many variables at play. But if you're starting to think about kind of what your income situation might look like in retirement and what your expenses might be, that can help inform the planning, both for your retirement and for eventually your estate. So we take that knowledge and then we put it into action. So what do? Well, go ahead and estimate your income and expenses in retirement, knowing that they will be imperfect. No one is judging you for what they are or are not. And depending on where you are in your career, if you have the ability and if the timing makes sense, go ahead and set aside some funds for your retirement to help protect you into your future, and so that we can help think about and plan what that future income in retirement might look like. It's not a bad idea to check in with your life insurance policy if you find yourself feeling underinsured, or maybe your life situation has changed, including something as simple as your children growing up a bit. When they were very little, you may have thought about a large life insurance policy to help cover the costs of daycare, for example. And maybe as they have gotten older, you are adjusting the amount of the policy that makes sense for you. That is all perfectly fine. Check in with an advisor, do a little gut check on your life insurance, and make sure the level makes sense to you. And if you are thinking about excluding those proceeds from your estate, maybe think about exploring an irrevocable trust that could make sense specifically to receive those life insurance proceeds, so they are not counted as part of the estate. Beyond the irrevocable life insurance trust, it might make sense for you to explore other trusts as well. Definitely consult with an estate planning attorney and maybe or an accountant on the nuances of that, particularly with respect to some of the specific questions about, how you might use it in your own situation. You may want to think about ways that you will spend down some of your retirement or some of your gross estate while you are still in a position to spend it down. So that might look like gifting investments. It might look like gifting property, especially to friends or family or others. And there might be a more comprehensive plan as part of that, especially if you are looking to reduce the value of your estate. Make sure that you or your surviving spouse have support when it comes to that estate tax return, especially so that you can preserve portability and take full advantage of that unlimited spousal deduction. So that might mean setting up that support in advance so that you or the surviving spouse knows who to call for support when and if that becomes something they have to engage with. And then, of course, do some due diligence. Think about the charities you'd like to support as part of your retirement and your life. and then certainly as part of your estate as well. These are the items that probably make sense to do regardless of the number of zeros in your estate. This idea of estimating your income and expenses in retirement, setting aside some funds, and then thinking about supporting friends and family and others through gifts that you can control definitely makes sense. And then I want to leave you with some resources for further reading, particularly as you continue to explore these. There is no substitute for consulting with your own expert. So definitely feel free to reach out to attorneys and accountants that could be able to support you, particularly if you're in one of those states that imposes its own estate tax, because there's an extra layer of planning there you'll want to think about. But the IRS resources I would direct you to, they have a remarkably good FAQ section that is linked here that you might find interesting. And then Form 706 is sort of the estate tax form, if you will, and then the instructions to the form often answer a lot of questions. They are not the easiest to read documents of all time, but they are remarkably good starting points for additional resources. And then there are some resources from some sources I know and love. The Balance has some really great resources, as does Smart Asset. Those are two really good resources as you think about maybe exploring some of these topics. And then there's some more detailed information on inherited IRA rules that you might want to explore, and also a great article from Forbes Advisor about student loans when you die. So with that, I will end with gratitude for your time, your energy, your questions, and your willingness to engage in these conversations. And I will also end with apologies about the transcript stopping midway through. I'm not sure if that ended up getting resolved, but I hope it did. And if it did not, perhaps that's something we can fix in post before the video gets posted. So with that, Deborah, I will return the floor to you to conclude our evening and take us out.
Thank you so much, Elaine. I told you she would make it easy. I think we all need to watch this video again. It will be in our YouTube, on the DG Copyright Management YouTube. The links are in the chat. It will be there within the next couple weeks. So thank you so much. And with that, have a wonderful evening.
Thanks, everyone. Bye.